Welcome back to RegTalkUK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
So, if you are currently finalizing your Q3 margin forecasts, you might want to just stop, hit delete, and throw them straight in the bin.
Yeah, quite literally.
Right, because a single drone strike in the Middle East has just forced the Bank of England to completely rewrite the UK's inflation trajectory.
And off the back of that, the Prudential Regulation Authority is basically ripping up the rulebook on liquidity.
Exactly. Plus, we're looking at a scenario where your automated KYC processes might have, well, just let in a massive wave of synthetic fraud. And that's all thanks to a really catastrophic 5-month security glitch at Companies House.
And look, as if that wasn't enough to keep your risk committees awake at night, we are also dissecting the biggest legal overhaul of the UK redress system in 2 decades. The Financial Ombudsman Service is officially being stripped of its quasi-regulator status.
Which is huge. Treasury is imposing a strict 10-year complaint limit, which fundamentally alters the legal defense strategy for, pretty much every product on your books.
Spot on. When you step back and look at the underlying pattern crossing our desks this week, it boils down to one undeniable shift. We are witnessing the great transition from a sort of permissive regulatory playground to a strictly predictable fortress.
Yeah, global macro shocks are forcing regulators to lock down the foundational rules of liquidity, whilst banks are being forced into deeply defensive postures against industrial-scale fraud.
All while simultaneously relying on the FCA's new, highly predictable rulebook to shield themselves from retrospective ombudsman rulings.
So our mission for this deep dive is to give you the ultimate roadmap for navigating this perfect storm of geopolitical stress and regulatory reform. We are examining updates from the FCA, the PRA, Treasury, and the Bank of England, really decoding the mechanics behind the headlines so you know exactly what to do on Monday morning.
Let's start with a macro reality check then. According to the Bank of England's March 2026 minutes, the Monetary Policy Committee voted unanimously to hold the bank rate at 3.75%.
Which, let's be honest, the entire city was pricing in a cut.
They were. But then we saw those retaliatory strikes on Qatar's Laffan LNG complex. That single geopolitical event spiked oil to $116 a barrel, and now the Bank of England sees near-term CPI inflation pushing back up to 3.5%.
And the transmission mechanism here is just incredibly direct. As reported by Sky News, the UK relies disproportionately on liquefied natural gas imports.
Right. Those strikes knocked out billion-dollar liquefaction trains that have a 5-year recovery timeline. So this isn't just a temporary blip, it is a structural energy shock.
Yeah, and what is critical for your balance sheet is how this macro shock immediately translates to prudential regulation. Because concurrently, the PRA published a major consultation, CP 526, to modernize the liquidity policy framework.
They are aggressively preparing the UK banking sector for a transition to a demand-driven, repo-led supply of reserves, which fundamentally changes how you manage a crisis.
Absolutely. The PRA looked at the 2023 banking turmoil, the rapid collapse of Silicon Valley Bank and Credit Suisse, and concluded that the old model of self-insuring is completely dead.
You can no longer just passively sit on a massive pile of liquid assets and assume you are safe.
Because digital bank runs materialize in a matter of hours, not days, the PRA now expects banks to actively manage pre-positioned collateral. You have to be able to monetize those assets instantly by accessing central bank's sterling repo facilities.
Exactly the mechanism. In the past, tapping the Bank of England's repo facility carried this enormous stigma.
Yeah.
It was viewed as the lender of last resort, a flare going up, that your institution was in deep distress. The PRA is explicitly trying to destigmatize this. They want borrowing from the Bank of England via these repo facilities to be treated as business as usual. But the operational burden this places on your Treasury teams is just immense. You need the plumbing in place to pledge collateral and receive reserves almost instantaneously.
It's essentially like a fire extinguisher. You can't just point to the heavy red cylinder sitting in a glass case on the wall and tell the PRA you're protected.
Yeah, they want to see it work.
Exactly. The regulator is demanding you prove that your teams know exactly how to smash the glass, pull the pin, and operate the machinery in under 60 seconds during a live stress event. But wait, we are demanding fortress-level liquidity from our banks while the national grid is running on fumes.
It is a profound contradiction, isn't it?
It's staggering hypocrisy. Mandating perfect operational readiness from the financial sector when the government's own energy policy leaves the UK with roughly 1 week of gas storage compared to Germany's 90 days.
Well, Commentators noted this week that relying so heavily on imported LNG rather than maintaining domestic North Sea gas infrastructure has created a sovereign vulnerability that the banking sector is now basically being asked to buffer.
Right.
As financial conditions tighten due to these delayed rate cuts, lending conditions will constrict. Mortgage defaults will likely tick up. Your operational vulnerabilities are going to be amplified across the board.
Which translates into very specific actions for you next week. On the strategy and commercial side, you must recalibrate your H2 margin forecasts. Just assume prolonged 3.75% rates as the baseline.
And on the risk side, audit your firm's operational readiness to execute central bank repo facilities. If your Treasury function requires 3 days of committee meetings and manual collateral sorting to access Bank of England cash, you have a massive red flag that the PRA will penalize.
But having rapid access to central bank cash means absolutely nothing if your underlying data infrastructure is compromised.
Right, because as financial conditions tighten, fraudsters actively exploit any operational crack they can find. Which brings us to a really catastrophic failure at the very heart of the UK's corporate registry.
Yeah. At the exact same time, the FCA and PRA confirmed new streamlined operational incident reporting rules, PS 726 and PS 262, requiring you to submit initial incident reports within 24 hours. We find out about a glaring 5-month misconfiguration in the company's house web filing service.
As reported by Tech Radar and Tax Policy Associates, this wasn't some sophisticated state-sponsored hack. Logged-in users could access any of the UK's 5 million registered companies' private dashboards by literally just pressing the browser's back button.
It sounds almost comical until you map out the damage. This glitch exposed non-public director details, full dates of birth, home addresses, and crucially allowed bad actors to alter company details.
Companies House temporarily became the most dangerous systemic fraud vector in the country.
Let's actually walk through the mechanics of the fraud loop here, because this is a direct injection of synthetic fraud into every retail bank's automated onboarding.
Yeah, lay it out.
Imagine a bad actor uses that back button glitch to access a dormant but legitimate logistics SME in Leeds. They quietly change the registered address and swap out the director's details for a synthetic identity. Then they ping your bank's automated KYC and credit onboarding API to apply for a £50,000 unsecured loan.
And because your automated API cross-references the now altered quote-unquote official government database, everything matches perfectly.
Exactly. The system instantly approves the funds. The money is offshore before the real director even wakes up.
If your bank relies heavily on scraping that API for frictionless SME onboarding, you have been fully exposed to a wave of this hijacked company's synthetic fraud for 5 solid months.
And this explains the immense tension right now surrounding the £100 contactless payment limit.
As reported by The Guardian, major high street banks are point-blank refusing to implement the FCA's proposed abolition of the contactless limit. The banking sector is already fighting a $1.17 billion payment fraud wildfire.
They cannot afford to embrace permissive deregulation like unlimited tapping when the foundational data systems verifying corporate identities are just fundamentally compromised.
The banks are basically acting like a bouncer, meticulously checking IDs at the front door of a nightclub, fully aware that the back door of the venue has just been taken completely off its hinges by the government itself.
That's spot on. Under the new Economic Crime and Corporate Transparency Act, there is a strict failure to prevent fraud offense. Are banks genuinely going to be penalized and hit with massive fines for authorizing fraudulent loans when it was the government's own registry that gets them the altered data?
Well, the regulator will absolutely hold the banks liable. Compliance teams right now are hyper-focused on setting up systems to meet the FCA's new 24-hour incident reporting deadlines. But they're completely ignoring the conduct risk of the company's house glitch. If a hijacked SME sues your bank for authorizing a fraudulent loan based on altered registry data, the FCA is not going to blame company's house. They're going to ask your risk committee why you didn't have secondary independent verification in place for automated lending.
You are expected to treat government data with the same zero-trust architecture as any third-party feed. So commercially, if you have any internal projects aimed at raising contactless limits, formally delay them. The fraud environment is simply too toxic right now to lower payment frictions.
And for your risk analytics teams, you need to run immediate anomaly detection sweeps on all SME accounts that were onboarded or modified over the last 5 months. Look for sudden changes in directorships immediately preceding maximum limit loan applications.
If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you.
So when automated onboarding lets in a wave of fraud or a complex financial product eventually fails, the resulting consumer disputes are about to be handled very differently. That brings us to the biggest structural overhaul of the UK redress system in 2 decades.
Treasury has announced landmark legislation to fundamentally defang the Financial Ombudsman Service, returning it to its original, narrower role.
For years, the industry has suffered under the FOS acting as a quasi-regulator. They would evaluate complaints based on a highly subjective, fair, and reasonable test.
But under this new legislation, that test is strictly adapted. If a firm can prove it met the FCA rules at the time of sale, the FOS is now legally required to find that they acted fairly.
Furthermore, they're establishing a 30-day FCA referral mechanism for any rule ambiguity, and most importantly, introducing an absolute 10-year time limit for complaints.
Which provides incredible regulatory coherence. It means product and legal teams can design a mortgage or an investment vehicle to exact FCA specifications without the constant lingering fear of subjective, retrospective punishment by an ombudsman deciding what they personally think is fair a decade down the line.
It fundamentally changes the legal defense strategy for every retail bank.
Previously, the FOS was like a referee deciding to invent a brand new offside rule in the 89th minute of a football match and then applying it retroactively to goals scored in the first half.
Exactly. Now, the rule book is permanently locked. And notice how this dovetails perfectly with the FCA's new incident reporting rules. The FCA is tightening its own grip on proactive harm identification and mass redress events under Finalized Guidance 262.
The regulator is pulling the power back to the center, curbing the ombudsman's independent authority.
But we do have to look at the severe consumer implications of this.
Yeah.
The 10-year statute of limitations provides phenomenal balance sheet certainty for a bank's legacy portfolios. You finally have a hard cutoff line.
Right, but for the retail customer, it creates a highly dangerous ticking clock. I'll push the analogy further. It is like the FCA has handed consumers a smoke detector for their financial products, but explicitly told them the batteries legally expire in exactly 10 years.
Yeah.
Even if the fire doesn't start until year 11, you are completely on your own. Doesn't strict rule adherence just give clever lawyers a license to design perfectly legal but morally bankrupt products, knowing the FOS can no longer use common sense fairness to force compensation?
That is the exact tension Treasury has created. It shifts the burden of vigilance entirely onto the retail customer. If a structural flaw in a compound interest product doesn't mathematically reveal itself until year 12, the consumer has no recourse.
So for your legal and compliance teams next week, you must rewrite your complaint handling templates immediately. You need to aggressively and specifically cite adherence to FCA rules as your primary bulletproof defense going forward.
And for your risk teams, review your legacy complaint portfolios to identify which systemic cases are going to safely time out under this new 10-year limit. You can potentially release significant capital provisions that were previously held against those legacy disputes.
That 10-year legal expiration date fundamentally changes the risk profile for products designed to last 3 decades. Which brings us nicely to the FCA's new focus on the biggest untapped balance sheet in the country, retirement lending.
According to the FCA's new market study MS 261.1 into later life mortgages, over 55s in the UK hold a staggering $3.7 trillion in property wealth.
Yet the retirement interest-only, or RIO market, saw a mere £282 million in sales last year.
The FCA is targeting funding barriers, strict MCOB affordability rules, and what they call the one-and-done factor, where consumers basically never switch products once they sign the initial contract.
And the demographic and economic pressure here is immense. 43% of Brits are actively undersaving for retirement. With the Bank of England holding rates high at 3.75%, standard mortgages are increasingly stretching into consumers' retirement years, creating a massive systemic risk.
Unlocking RIO mortgages isn't just a regulatory talking point. It is a vital commercial opportunity for retail banks to monetize that $3.7 trillion, provided the FCA eases the strict affordability checks.
But tie this back to the FOS reforms we just discussed. Lifetime mortgages are 20 to 30-year products. If you missell a complex reverse mortgage today, the new 10-year FOS time limit might expire a full decade before the consumer realizes that compounding interest has entirely eaten away their estate.
The initial point of sale becomes incredibly high stakes because there is no safety net later, and the current market structure makes that point of sale a trap. The UK lifetime mortgage market is fundamentally inflexible.
It is a financial lobster trap. Very easy to walk into, practically impossible to leave or switch to a better rate.
Yeah.
The FCA is pushing for what they call holistic advice to solve this inflexibility. But can technology actually deliver complex, multi-layered advice spanning tax implications, means-tested state benefits, and property wealth?
We saw reports this week of an Indian AI joint venture entering the UK advice market with Fintel.
Right. Is deploying generative AI to guide vulnerable pensioners through reverse mortgages genuine holistic advice, or is it just the architecture for automated mis-selling at unprecedented scale?
Well, that AI joint venture poses a massive conduct risk, precisely because of the underlying plumbing of the market. Everyone complains about the lack of product mobility, the fact that pensioners can't easily switch rates, but the lack of product mobility isn't a bug, it is a feature deeply embedded in the securitization model.
Okay, walk us through that.
When a retail bank originates a lifetime mortgage, they aren't holding that 30-year risk on their own books. They securitize it. The insurers funding these loans require fixed, long-term yields to match their strict annuity liabilities. If the consumer pays off the loan early or switches to a competitor, the insurer's liability matching breaks down.
Ah, I see. So if the FCA truly wants a dynamic, switchable reverse mortgage market like we see in Australia or the US, they can't just mandate better advice. They have to rip up the entire underlying securitization model of UK banking.
Exactly. It requires changing the plumbing, not just tweaking the tap, which means your strategy and commercial teams need to prepare their data next week. The FCA will be sending out requests for information.
You need to explain exactly, using the securitization logic, why your standard lending arms are actively avoiding the REO market.
And your risk teams must rigorously evaluate the conduct risk of deploying any AI-driven holistic advice tools, especially when targeting vulnerable, older demographics with irreversible financial products.
Let's pull all of this together and recap the vital takeaways. The Bank of England's rate hold means liquidity stress is a permanent fixture. You must get your repo operations ready to pull the pin in under 60 seconds.
The company's house glitch requires immediate defensive analytics on your SME onboarding to catch the synthetic fraud loop that has been running for the last 5 months.
The FOS reforms provide total regulatory certainty and a 10-year complaint cap. Rewrite your defenses to leverage it immediately.
And the $3.7 trillion later life mortgage market is about to be cracked wide open, but beware of the securitization trap. One final, crucial watch out from the incident reporting rules. There will be a new single reporting portal for both FCA and PRA incidents.
You have exactly 12 months to align your internal severity matrices to ensure you aren't underreporting to one regulator and overreporting to the other. To wrap up, I want to leave you with a final thought to mull over. With the FOS stripped of its broad, subjective discretion and a hard 10-year limit firmly in place, we are entering a strict new era where the letter of the law officially trumps the spirit of fairness. If the next major mis-selling scandal is a highly complex AI-advised retirement product that brews slowly over 15 years, well, who is actually going to catch it?
Good question.
Are we looking at a UK banking system that is genuinely safer today, or have we just engineered a system that is legally bulletproof for the banks?
That's all from us this week. Thanks for listening to RegTalkUK. Until next time, stay sharp, stay informed, and stay compliant.